And that fear and greed leads straight to the single biggest mistake investors make. It's so common it has a name: buying high and selling low. People buy when everything feels euphoric, then panic sell at the very bottom. Think about how backwards that is. They buy when prices are expensive because everyone's excited, and they sell when prices are cheap because everyone's scared. That's the exact opposite of how you make money. Wrong move, worst moment. It feels right in the moment though. When everyone around you is panicking, selling feels safe. When everyone's getting rich, buying feels smart. Your emotions are screaming the wrong instructions, and most people obey them. That's why most people underperform the market. So can't you just be clever and time it? Sell before the crash, buy back at the bottom? Sounds great in theory. In reality, timing the market almost always backfires. Nobody rings a bell at the top or the bottom. You're guessing. Here's the brutal part. The market's best days often come right after the worst days, in the middle of the chaos. If you sell in a panic, you're in cash when the rebound hits. Miss those days and your returns get wrecked. Studies show that missing just the 10 best days over a couple of decades can roughly cut your total return in half. And those days cluster in the scariest moments. The only way to catch them is to never leave the market. So how should you actually react when the market drops and your stomach is in knots? Here's the playbook. 5 simple moves that turn you from a panicked seller into a calm, wealthy, long-term investor. None are complicated. Move 1. Stay invested. This is the foundation of everything. Don't sell in a panic. When the market drops, the worst thing you can do is lock in losses by selling. Hold on and let history do its job. Just stay put. Move 2. Keep dollar cost averaging on autopilot. That means investing a fixed amount on a regular schedule, no matter what the market's doing. When prices drop, your same dollars buy more shares. You turn volatility into your friend. Move 3. Keep an emergency fund. Stash 3 to 6 months of expenses in cash, separate from your investments. Why? So when life throws a surprise bill during a crash, you're never forced to sell at the worst possible time. Move 4. Rebalance to your target. Over time, winners grow and losers shrink, knocking your mix off balance. Once in a while, trim what's grown too big and top up what's lagged. This quietly forces you to sell high and buy low. Move 5. The mindset shift that changes everything. Reframe a bear market as a sale. When stocks drop 30%, your favorite companies just went on discount. Long-term investors aren't losing. They're buying great assets at a markdown. Let that sink in. Every other shopper runs out of the store screaming when prices get cut. You're the one calmly filling your cart. The crash that terrifies everyone else is the exact moment the patient investor builds serious, life-changing wealth. And you don't need to be a genius to pull this off. You don't need to predict anything or watch the market all day. You just need to stay calm, keep investing, and refuse to panic. That discipline beats brilliance every time. The investors who win aren't the smartest in the room. They're the ones who controlled their emotions when it mattered most. You now know more about market cycles than the panicking crowd ever will. That's a genuine, lasting edge. Let's lock it in. Pullbacks are under 10%, corrections 10 to 20, bear markets 20 or more, and bulls are the long climbs that follow. Bulls last longer and rise more than bears fall. The market has always recovered, always. Remember the big stat, roughly 10% a year over the long run. But only if you stay invested through the scary parts. Don't time the market. Stay in, average down, keep your emergency fund, rebalance, and shop the sales. Here's my question. What's the scariest market drop you've lived through, and did you hold or panic? Tell me in the comments. If this made downturns less scary, hit like, subscribe for more, and share it with someone who needs it. Your portfolio drops 20%, and your stomach drops with it. Everyone is panicking. Here's the truth nobody tells you. That crash is normal. It's temporary, and how you react in this moment decides whether you win or lose. Most people lose money in the market, not because they pick bad investments, but because they panic at exactly the wrong time. They feel rich at the top and terrified at the bottom, and they act on those feelings. That's the trap. By the end of this video, you'll understand every market phase, why prices swing, and the exact calm playbook that turns scary downturns into your biggest opportunities. Master this, and market crashes stop being a threat and start being a gift. First, let's kill the confusion. The financial news throws scary words at you constantly. Pullback, correction, bear market, bull market. They sound terrifying, but they're just labels for how far prices have moved. Learn the latter and the fear melts away. Rung 1, the pullback. This is a small dip, less than 10% off recent highs. It happens all the time, sometimes several times a year. A pullback is just the market catching its breath. It's not a fire. Rung 2, the correction. This is a deeper decline, between 10 and 20% down from the highs. Sounds scary, right? But on average, a correction happens roughly once a year. It's routine, not the end of the world. Rung 3, the bear market. This is a drop of 20% or more from recent highs. It usually comes wrapped in gloom and pessimism, and often, though not always, alongside a recession. This is where most people blunder. Rung 4, the bull market. This is a sustained climb, generally marked as 20% or more up from the lows. Optimism returns, prices rise, confidence builds. Bull markets are where patient investors quietly build fortunes. So that's the ladder: pullback, correction, bear, bull. Now, here's the most reassuring fact in all of investing, the one that should let you sleep at night even when the headlines are screaming that the sky is falling. Listen closely. Bull markets last far longer and rise far more than bear markets fall. A typical bear historically lasts under a year, very roughly 9 to 12 months, and drops around 30%. But bulls can run for years. Think about what that means. The pain is short, the gains are long. You suffer through a downturn for months, but you're rewarded with years of growth on the other side. The math is overwhelmingly tilted in your favor. And here's the kicker. The market has recovered from every single downturn in history and gone on to make brand new highs. Every crash, every panic, every so-called end of the world, each became just a dip on a long upward chart. The Great Depression, the dot-com bust, the 2008 financial crisis, the pandemic crash. Each one felt like the end at the time. Each one fully recovered and pushed to new records. The downturns are real, but so is the relentless long-term climb. Now the big number. Despite countless crashes, recessions, and bear markets, the S&P 500 has returned roughly 10% per year on average over the long run. That single fact has built more wealth than almost any other in modern history. But there's a catch, and it's the whole game. You only capture that 10% if you stay invested through the scary parts. The crashes aren't a bug in that return, they're built into it. The average already includes every drop. Read that again. The 10% average already bakes in the depressions, the crashes, the bears, all of it. You don't earn that return despite the downturns. You earn it because you held on while everyone else panicked. So why do markets swing up and down in the first place? 5 big forces. The first is the economic cycle. Economies naturally expand and contract over time, and stock prices ride along with that rhythm of growth and slowdown. The second force is interest rates. When central banks raise rates, borrowing gets expensive and stocks often cool off. When they cut rates, money gets cheaper and markets tend to heat up. Rates are like the thermostat for the whole economy. The third force is inflation. When prices for everything rise too fast, it eats into company profits and makes investors nervous. A little inflation is healthy, but too much can spook the entire market and send prices tumbling lower. The fourth force is corporate earnings. At the end of the day, a stock is a piece of a real business. When companies earn more, their shares are worth more. When profits shrink, prices usually follow. Earnings are the foundation. And the fifth force is the most human of all, plain old fear and greed. When people get greedy, they pile in and push prices too high. When fear takes over, they dump everything too low. Emotion moves markets more than logic.